I thought there was a very interesting survey from our friends at the monthly survey from our friends at Bank of America, who do the survey of institutional investors. And there were a lot of inconsistencies actually in the results of that survey, but the overall theme was that institutional investors are still very much running low-risk positions. So cash levels are at a very high level. When I say it's inconsistent, yes, cash is at a high level, but one of the most crowded trades is investors are very long the tech sector. So you have almost that sort of barbell of long tech and long cash, plus in addition, very big positions long fixed income markets. There is obviously a degree of inconsistency of that, because do you want to be long the US Treasury market, particularly the short end of the US Treasury market, if we are going to have a challenge with the cash flows and the payments from the US Treasury over the debt ceiling? Coming back to your question about what the Fed's going to do, there has been a slight shift in futures markets over the last 2 weeks to reducing the expectation of interest rate cuts later in the year. Having said that, investors and markets are still discounting the Fed's going to cut. In my view, and I've said this repeatedly on CNBC, is that yes, I think the chance of the Fed raising rates further is now very limited, but I think it's very naive to assume that the Fed's going to cut interest rates for possibly in 2024, but certainly not in 2023. And I think the markets are probably going to have to make a further adjustment.
I'm just going to pluck out one point from that commentary, and that is around technology names and the rally that we've watched. There was a view that last cycle around, when we saw enormous strength in the tech sector, it was based on some of the innovation that these technologies were bringing. They were just immune to the economic cycle. But one commentator said to us recently that had run out of steam because we're much further along when it comes to the innovation curve. That's changed in recent months with AI, and the stocks that we've seen that have really just gone for it in recent weeks have been around the AI story. Could that be the same? You're not actually going to lose out on some of these tech bets that are specifically focused around the AI strength.
Well, I think there are two factors here. First of all, if you look at investor surveys, it's very clear that the most crowded trade, apart from these cash positions, is in the tech sector. And one theme for investors is to focus on companies which are developing AI in one form or another. So that's theme number one, which is investors want to participate in the development of AI, and that obviously comes with a whole series of risk warnings. The second factor is that if you're concerned about companies with too much debt, then you like the tech sector because cash flows are still very strong, liquidity is very high, there is very little debt in the tech sector. So arguably, the tech sector is less vulnerable to higher interest rates, it's less vulnerable to recession. And personally, I disagree with this, but some investors are saying that the tech sector is now actually reasonably defensive. So you've got the play on AI plus the play.
Only. Not all tech, but just big cap.
Big cap,
yes.
Yeah, very much the big cap.